Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So in today's video, we're just going to do another review of velocity banking. I've labeled it Developing Our Superpower to Eliminate Debt with Velocity Banking. And this was just kind of me inspired by playing around with the Meta AI. So I've been using the Meta AI on WhatsApp and I said, please draw me these velocity banking pictures. So this one's like Velocity Banking, the comic book, right? Velocity Banking cult because someone said, "Hey, this is a cult," and I think they're a fan of this channel too. I don't know. This is, I guess I'm a cult leader, and this is what I look like. I don't know. Like look at the tenants, faster, higher. I don't know what this word even is. And then scroll down, Velocity Banking, the anime. I tried typing in Velocity Banking superheroes because I was like, what does the AI think that would be? And unfortunately, it didn't produce anything meaningful. It just produced images of Batman or something that looked like Batman. I didn't see anything with related to a dollar sign or a credit card or anything like that. But we're just going to assume that one day I'll figure out how to make the Meta AI generate a cool velocity banking superhero image. Hopefully, we'll be able to do it one day. But we'll just develop our superpower to eliminate debt using velocity banking. And I don't know if you knew this or not, but a lot of people out there think that debt is this lifetime thing that you just kind of pay, right? Like student loans. I heard, from an instructor who taught velocity banking. His name is Randall. He's the instructor for Renatus. That when he first taught it in New York, the attitude there was that you have student loans for a lifetime, right? Whereas he's from Utah, and that's what he says that that's totally not the attitude. And then another thing too is if you just kind of think about the 30-year mortgage, I mean, isn't it insane that a loan would last basically a lifetime, which is 30 years? That's a huge, that's a big, or that's a long time, right? That's a long time. That's basically a lifetime. And so what we're going to do is pay off all our debts quickly. And how do we develop our superpower to do that? Well, we do it with these Excel spreadsheets, right? That's how we develop our superpowers, and we do it over and over again. And that's how we're going to eliminate debt. It's something called velocity banking. What is velocity banking? All it is a debt payoff strategy using a line of credit as your main tool to do that, right? And one thing I do want to mention is that let's assume that we have a 100K income. Now, I know that 100K nowadays, based because of inflation and all that good stuff, isn't really that much, or the perception is it's not that much, right? And if you had this income and you had all these debt payments, right? So we've added it up, it's about $1,775. What is the amount of home you can comfortably afford? If you take a look at Zillow and you put in these numbers, it says that you can afford a home up to $200,000, which is not that much nowadays. I was looking at sold home prices in Northwest Georgia, Smyrna, and those I saw like a two-bed, one-bath home sell for like 300,000, 15. So we got to be careful about buying homes and making sure that we buy at the right price, right? And there are ways to always buy under market value, but we just got to do the exact opposite of mainstream society, which is simply overpaying for homes. And because they overpay, that's why so many millennials regret buying a home. And I don't know if you ever looked at the statistic, 90% of millennials regret buying a home in 2024, right? Because they simply overpaid. Home ownership is, quote, the American dream. And I don't know if you ever heard that George Carlin quote. You got to be asleep to believe it. Right? So let's just assume that we bought a home we can afford, okay, and $50,000 down payment. So that's a $140,000 loan. Um, let's just assume that it's $150,000. I don't know, 6%, 899, and we got $2,500 in general expenses that never go away. So the whole point of this is that we have a budget, and this is our debt attack plan. And the more debt that we pay off, right, the more cash flow we get. Okay, that's the name of the game. And so, how do we do this? Again, number one is the budget. Since I've already done that, income expenses. We bought a home that we can afford. Now, is buying a $200,000 home possible in Georgia? Yes, it is. Depends on the area, but it also depends on if you can get a discounted property or not. And that's what we specialize in as real estate investors, getting discounted properties. And if you want to get a discounted property, there are people who you can talk to, like wholesalers. That's what they specialize in. They get a discounted property in a contract, and then they sell that contract to flippers. Maybe you want to talk to a wholesaler. I heard most of them are pretty bad because they're just trying to they overstate the market value and the understate the repairs. But you do your due diligence, right? So that's someone who I might talk to who might be a good source of deals for properties that whose market value or whose price is under market value, right? But let's just go ahead and do the next step, which is having a line of credit as our main operating account. Line of credit. So what is a line of credit? All it is a financial tool where you could borrow money, pay back, and use it over and over again, right? And these examples, I usually typically use a HELOC because a home equity line of credit is has the best rates and the best limits. And if we're a homeowner, why wouldn't we get it, right? Why wouldn't we get it as a home? Use all the tools available. And if you don't have access to a home equity line of credit, then get a personal line of credit. And in fact, I got all of them. I got over $279,000 in lines of credit, right? So actually, let me recalculate this. I don't think so. Our goal is to first pay off all the credit card debt, and I think I wrote the wrong number, but let me just verify. 5 plus 8 plus 27 plus 7 plus 10, right? Oh, that's 57K of credit card debt, right? Okay, so we paid off the $57,000. We're going to pay off this $57,000 of credit card debt first. And let's just assume we have a pretty big line. I don't know, 130. I don't think we even need the $130,000 available. But it's based on equity, and all equity is the value of your home minus this outstanding debt that you have. And homes have appreciated greatly since 2019, right? I thought that homes were going to crash in 2019 because I was like, this is unsustainable. And then somehow everybody has all this money to buy real estate. I don't know how that's even possible. Yet they all regret it, right? So, all right. Um, let's just do this, okay? And actually, let's assume we have maybe a $60,000 line available at a 9% interest rate. So we always assume two things with our finances, that our finances stay the same, that our income stays the same, which is perfectly fine, although you always want to make more money, right? I'm always striving to make more money, right? You want to maybe get a rental property if you can afford it, or you make extra income with YouTube, which is what I'm doing right now. I get about $400 to $500 a month. So don't, even though we assume here for the purposes of this exercise that our income stays the same, try everything you can to get more income, right? There's nothing wrong with it. Although a lot of people always like to put a poker face to act like they're not trying. All right. And then here, we're going to assume zero savings, right? So there's going to be no savings. This is one of the most important parts and tenets of velocity banking is that we're going to dump all our income into our line of credit as our main operating account, all right? And then we're just going to do some re-engineering or refactoring or rejiggering or whatever word you want to use to our expenses to increase something called our cash flow, which is our income minus expenses, right? So the income minus expenses looks exactly like the savings for the average American, okay? But we got to move around some debts to make our line of credit as our main operating account. So here, the average American, the main operating account is the checking account. For the Velocity Banker, the main operating account is the line of credit. And so we haven't used the line of credit yet. So let's go ahead and transfer some debt. So we have these 5 credit cards, right? 1, 2, 3, 4, 5. We summed up, and it's $57,000 of debt. So I'm going to put in $57,000 of debt here. And you know what? I think you guys are keeping me on track because some of you are like, hey, in previous videos, we added the credit cards up, and it's you actually were off by 10,000. I was like, dang, you're right, but it means you're paying attention to me, which is good because I need people to correct me. Because sometimes even in my real life, I go crazy because I explain this concept to other people, and then they act like they're too good for it, or they're not paying attention, or something. So I don't want to be the only one in my circle to pay off debt quickly while everyone else is like struggling financially. All right, so let's go ahead and move this $57,000. And by moving this credit card debt, oh my goodness, what happens? These payments go to zero. Wow. And so we went from $824 in savings to $2,600 of cash flow. And so now the actual strategy itself is this entire $6,000 will go into this $57,000 line of credit. And then this $3,000 will come from this line of credit, right? And then after every single month, the balance will go down by $2,600, right? And plus some interest. And it's really easy to calculate that. So what we do is just get the next month. So we get the previous month plus one. Next month's balance is the previous month's balance plus the previous month's interest minus this $2,600 of cash flow. And how do we calculate the interest? Well, we get it with the average daily balance. So we can estimate using this average function, multiply it by this interest rate, which is 0.09, divided by 12. And hey, it doesn't matter what the interest rate, oh, it kind of matters what the interest rate, but not really. Because even if we did like 15, the debt payoff would pretty much be the same with a little bit higher interest, okay? I'm sorry. All right, so now we got the formulas in, and let's see how long it takes us to pay off that $57,000 of debt, okay? So let's go ahead and do that. And so it's going to take us about 2 years, right? So 2 years to pay off $57,000 of debt. Not bad. So let's go ahead and write that. So 57K and 2 years, right? And these are our milestones. And then next is the mortgage. So typically, when it comes to the mortgage, you have two options. Number one, you have the default option, which is making extra payments directly from your cash savings, right? Or you can use a line of credit. Now, there's a lot of arguments against using a line of credit. Oh my goodness, it's a higher interest rate. But here's the thing. If for most people, they will never use the default option, right? If I put this entire $2,600 into the mortgage, I can never get it back, and a lot of people freak out about that, right? A lot of people freak out. So as an alternative, as an easy alternative, without having to think too much, because if you ever made extra payments to a loan and you typically needed more money, um, because for whatever reason, it's a little bit harder to figure out, like, okay, do I send the whole thing to the loan or do I take out some of the expenses? One of the things you could just do is simply just move portions of the loan line of credit, dump your paycheck, and if you have some variable expenses, whoop-de-doo, it doesn't matter. You made it easy for yourself, right? And a lot of times people don't understand. Sometimes if you just make things easy for people, where you just don't have to think that much, that itself has a lot of value. And I've used this analogy before where it's kind of like UPS trucks making left turns, right? Yeah, you can make a left turn on a road, but UPS actually tells their drivers don't make left turns because left turns are a source of trouble. I equate left turns to making direct extra payments to the loan. Always make right turns, right? And if you don't believe me, go ahead and look it up on Google. UPS left turn trucks, right? And tons of articles about how UPS drivers don't make left turns because left turns are like a source of trouble, right? Why UPS trucks almost never turn left. Harvard Business Review, ever notice that UPS trucks rarely make left turns? Now you could be a smart aleck and say, well, the left turn is right there. You just make a left turn, right? And it's the same thing with extra payments. Like, why wouldn't you just dump extra cash into the loan? Because liquidity problems, loans are one-way streets. If you use credit cards and lines of credit as backup, now you have a problem of something called segregation of income, which we didn't go to. So just make it easy on yourself, right? And so let's say we move 7,000. How much is our income? Let's say $6,000. Small chunks and pieces into that line of credit. So that would be 144K. That would be the current balance. So let's move $6,000 into the line of credit right here, right? Plus $6,000. How long does it take to pay that off? Oh my goodness, 3 months, right? And then if we go to a loan amortization schedule to get to 150 to, let me go back here, 150 to 144, how long does it typically take if we're just doing it the way the bank wants us to? Um, about 3 years, right? So 3 months versus 3 years, and we made it easy on ourselves. Like that itself has incredible value because one way you can do it, but you're not actually going to do it because you look at statistics. Most people never pay a 30-year mortgage 30 years, even though they have this option to directly dump in cash. Whereas if we just move it to the line of credit and we put our entire paycheck in, it'll pretty much be the same and you'll actually do it, right? So luckily we have this thing called a velocity banking calculator from Renatus, which is where I first learned velocity banking from. And they have this cool calculator where you just input the numbers and it'll tell you the payoff and how much interest that you can potentially save. Now, full disclosure, I make money off of selling uh, Renatus educational products, so I'm probably going to put in some plugs about this later on. But I do make commission, and this is where I first learned it in 2017. Okay, so they call us independent contracted marketers, so not an employee, but I do make money off of selling their products, kind of like someone who sells insurance. All right, so now let's go ahead and put this in. Let's do 6,000. No, what's $150,000 original balance, and then 144. Well, actually, what's the current balance after 2 years? So the current balance after 2 years would be $146,000. $146,000, right? And then the interest rate is 6%, 30 years, and what is the payment amount? 899.33. And then we'll say that we're just going to move it in $6,000 chunks at a 9% line of credit, and our income is 6,000. And what is our expenses? Everything except for the loan we're trying to pay off. So 2,500 right here. So 2,500, and take a look at that. 4 years. Whoa, mind blown. That's a superpower. If you can pay off a mortgage in 4 years, that's a total superpower. You know what I'm saying? So in this mortgage, we would have paid $155,000 if we just did it the way that they want us. And we probably would have paid more if we refinanced. I think we would have, unless there's a significant interest rate drop, right? So maybe if you go to 6 to 2.5%, I don't know. We'll see. So, but here's the thing I really want to emphasize. And again, I've heard this a lot in places on the internet where why don't you always replace your mortgage with a first lien HELOC, right? So if we did that, it's 4.2 years and we save a lot of money. Okay, we save a lot of money, but we still pay more interest. So it's like, why would you pay like double the interest when you don't have to, right? So if you do it in small chunks, this is for some reason, I don't know why, I just know it is resistant to the interest rate. So let's say I do this with the 30% credit card, okay, 30%. Look how you still pay less with a 30% credit card than a first lien HELOC at 9%. Isn't that crazy? Right? So, something to think about. In my opinion, we only should get first lien HELOCs after we've paid off all of our debts in the property or tied to the property, because that HELOC could be used for your cash flow management, or maybe possibly, again, this depends on what agreement you have with your lender, making down payments for homes might be, right? I don't know. Sometimes lenders do prohibit that based on the documents you have to sign, so you always have to like call them and say, hey, I might do this or XYZ. Is it prohibited or not? And you always want to be honest, right? So something to think about. But yeah, so yeah, we just kind of did this. Look how easy it was, and 4 years, 4 years till the debt payoff. So what we're going to do is just write all this. So 157, so it's 207K plus 2 plus 4 is 6 years, and we are debt free. Debt free, right? We developed our velocity banking superpower by doing these spreadsheets over and over again. And it's so easy. Oh my goodness. And you know what's crazy? I think I'll have a mortgage paid off next month. And it'll be 3 years or before 3 years? Is it 2 years? Oh my goodness. I'm going to faint. Okay, well, that's it for today. So, yeah, another velocity banking review session. who knows? Let's see if I could get to 10,000 videos. Sometimes I feel like really inspired to do these, and then sometimes I feel like, oh, another video. But I always know that consistency beats like passion, or what do you call it? You always want to be the tortoise versus the hare. So I'm always trying to be a tortoise with these things and just uploading another video every single day and being consistent. Sometimes I'm just so tired for whatever reason that I can't do it, but I think I'm really more inspired to upload videos now. All right, well, that's it for today, everybody. Have a great day, and we'll speak next time.